In line with the trend in the last few years, central banks were once again put to the ultimate test to stabilize their economies against continuous, colossal and complex shocks. Central banks are constantly adapting to the new global economic and financial landscape created by geopolitical conflicts, geoeconomic fragmentation, financial market volatility and continuing uncertainties, all of which are testing the resilience of the global economy. The last mile of disinflation is turning out to be prolonged and arduous, both for the advanced economies as well as the emerging market economies, that is the EMEs. Maintaining macroeconomic and financial stability and building buffers continue to be the lodestar, especially for the emerging market economies. In India, notwithstanding the recent aberration in growth and inflation trajectories, the economy continues its journey on a sustained and balanced path towards progress. Amidst the reshaping of the global economy, India is well positioned to benefit from the emerging trends as it forges ahead on a transformative journey. Let me now turn to the decisions and deliberations of the Monetary Policy Committee, which met on 4th, 5th and today 6th December. After detailed assessment of the evolving macroeconomic and financial developments and the outlook, because monetary policy is forward-looking, so we have to always look at the outlook, the Monetary Policy Committee decided by a majority of 4:2 to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25% and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%. The MPC also decided unanimously to continue with the neutral stance and to remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. I shall now briefly set out the rationale for these decisions. The MPC took note of the recent slowdown in the growth momentum, which translates into a downward revision in the growth forecast for the current year. Going forward into the second half of this year and the next year, the MPC assessed the growth outlook to be resilient, but warranting close monitoring. Inflation, on the other hand, surged above the upper tolerance band of 6% in October, driven by a sharp uptick in food inflation. Food inflation pressures are likely to linger in Q3 of the current financial year and start easing only from the Q4 of the current financial year, that is from January to March. And we expect that this is the trend and it will be backed by seasonal correction in vegetables prices, Kharif harvest arrivals, likely good Rabi output and adequate cereal buffer stocks. High inflation reduces the disposable income in the hands of consumers and dents private consumption, which negatively impacts the real GDP growth. The increasing incidence of adverse weather events, heightened geopolitical uncertainties, and financial market volatility pose upside risks to inflation. The MPC believes that only with durable price stability can strong foundations be secured for high growth. The MPC remains committed to restoring the inflation growth balance. I repeat, the MPC remains committed to restoring the inflation growth balance in the overall interest of the economy. Accordingly, the MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting and also to continue with the neutral stance of monetary policy as it provides flexibility to monitor and assess the outlook on inflation and growth and then go on to act appropriately. I would now like to provide an assessment of growth and inflation, and I would like to begin with the global growth scenario. The global economy has shown unusual resilience in 2024, despite several headwinds.
Well, that was the governor of the RBI giving us insights into how India's economy is, and the repo rate remains largely unchanged. Priyanka is joining me live from the newsroom. Priyanka, the key takeaways are that the Indian economy is on the right path. There is growth. The growth is also resilient, is what the RBI governor was informed by the MPC, and the repo rate remains unchanged. Take us through these key takeaways.
That's right, Deepak. In fact, the decision to keep the rate unchanged at 6.5%, it was along expected lines, really, as Shaktikanta Das also emphasized that the focus is on taming inflation rate, which is currently at about 6%. And in fact, the GDP growth too that he mentioned in October has slowed down to a two-year growth of 5.4%, which definitely had impacted with the decision to keep the unchanged rate at 6.5%. Do note that this is in fact the 11th time, in fact the consecutive meeting, for the 11th time that the repo rate has been kept unchanged. It was last hiked in February 2023, in fact. Also, this is in the meeting, as you mentioned as well, Deepak, that Shaktikanta Das has emphasized not only the price stability but also the resilient Indian economy. But he has also highlighted that the inflation rate, which has been a concern for the last couple of quarters, due to the really persistent rise in food prices, is something that they will also closely keep an eye out for the next couple of quarters. In fact, when we spoke to some experts, they were also of the opinion that it was likely to be unchanged at 6.5%, the repo rate. And there are expectations, though, that in the next meeting, which will be held in February 2025, there might be a possibility of a rate hike, a rate cut. But this is, again, considering the economic indicators that we might witness in the next couple of months and give us more economic cues, really, as to what to expect. But as of now, as the major thing that Shaktikant Das has been mentioning is that the focus is on keeping the repo rate unchanged at 6.5%, but the stance is going to also be kept at neutral, which was last changed in the October meeting.